Hey everyone, welcome to another edition of our Smart Investing weekly stock analysis, where we break down popular companies using fundamental analysis and provide advice that is truly unbiased and has no strings attached. And if you like what you hear this week, don't be afraid to subscribe to our channel. We're going to continue to give you that weekly stock analysis below. Today, we're going to talk a little bit more about real estate. I mean, real estate's a pretty hot topic. A lot of people are intrigued by it. Give a little bit of our projections and some things you got to watch out for, some pitfalls as well.
Hey, so before we get started, I'm just looking at the picture of you right now. I think we have to set it up so you move a little bit to, I think you're right. So you get a better picture of your jersey from Northern Arizona. I mean, it's such a nice looking jersey.
Hey,
Yeah,
and they use a good spot there, Flagstaff. Gotta love it.
great,
Real
great.
estate's a little cheaper out there than San Diego, by the way.
It is a little bit cheaper out there, yeah. But I don't know if I want to live there long term. But anyways, yeah. So I mean, real estate right now is pretty hot. You've got this frenzy going on right now. So we've kind of done some research ourselves, saying because we do like to buy low and sell high. And I do worry about the real estate market, that you could be buying high and waiting for a long time. I do not see a crash coming, but I could see somebody buying real estate now and waiting for a long time for a decent return. So that's one thing we're going to talk about. And I know right now that rental property investing is very hot, but you got to invest in the right properties and the right type of properties to make returns long term.
Yeah, and we have some better kind of ideas, I think, than buying individual properties, and we'll talk about that a little bit later. But I do want to start with our really projections for the real estate market projections for 2022. This year, I mean, real estate it's just on fire. You kind of mentioned that already. I think we've seen record after record in terms of year over year home price appreciation, around 14, 15%. It's just been a phenomenal year as the demand is so high, but supply is so constrained. But you can't expect that in 2022. You're going to continue to see 15% climbs.
Right. And one thing we have written over the time, and again, we're on social media, they can go to our website, smartinvesting2000.com, because what we actually do have there is things we've written about in the past that we've kind of built over time on some things that maybe the affordability index, where the rates rise. I mean, all these things we try to help investors out with to really understand the true fundamentals of investing to help them make wiser long-term decisions as opposed to a gambling guess, I'll call it short term.
Yeah, and I do want to kind of throw out some numbers, some ideas there. I mean, as I said, I think the remainder of this year, the real estate market, it's going to remain, I think, on fire. I mean, it's just been just such a high level demand. So I would not be surprised to continue to see maybe even new records here for year over year increases. I don't think that means you go out and buy a property right now because, again, that's year over year, not month over month. I think come 2022, you're going to be utterly disappointed by maybe low single digit returns. And as you said, over the next 10 years, I just don't see the home prices really appreciating too much. And, we don't like to give short term forecasts too often, but just even going out to 2022, I don't see a huge climb. I see a mediocre climb at best. And people, oh, you think there's going to be a big crash? We don't see a big crash because there's so much money in the economy. But would not be surprised to see a small pullback and then a very slow appreciation from there.
Yep. And that's so important. We've looked at these things over time. And again, I talked about too how some younger people buying homes now, they're kind of, I forget the numbers, your memory is better than mine. I think almost a third were disappointed after the purchase for different reasons. And that's not good long term because they start talking to their friends and so forth, like, oh, don't buy, don't buy. And all of a sudden, something's going to change the market because nothing goes to the moon and prices. And it's not just here in San Diego. I mean, it is nationwide. Many hotspots will call for real estate, and it just does not continue. And you should never buy high. So,
Yeah, and the thing we look at too is the people waiving appraisals, people waiving inspections. I mean, that's a big one for me. And it's interesting. I was talking to a friend, and they had a friend actually that bought a house here in Vista, never visited the home, waived the appraisal, waived the inspection. They moved into the house, realized that the neighborhood was not what they had anticipated. The house had issues. Like, oh my gosh, what did we do? And that is what you call a frothy market. You do not want to be buying in frothy markets.
and Chase, one benefit we have too of being in the investment world, we do talk to a lot of different people. We have, clients come in, potential clients come in. So we talk to a lot of different people. And we hear stories of people saying, yeah, I bought the house and 2 months later I hated it. They couldn't sell it what they paid for it. Plus, they had to pay another commission to sell it.
Yeah.
I mean, it's just you hear more and more of these stories. And I would say we talked to quite a few people between our radio show, clients, and just going out in general. People know what we do. I always ask for information. Like I went to do a radio show commercial today for our radio program. And the woman asked me, I got a question about investing. It was like some crazy deal with her daughter and somebody passed away and they want to give the house and so forth. So my point being, I'm getting way off track, but we have a lot of conversations about what we do because people know what we do and we hear things that the average person probably would not hear.
Yeah, I mean, kind of just piggybacking on that story is interesting. I was talking to a younger lady, what was that, about a week ago, and she had just bought a condo. And she's like, well, prices like they just always go up, so it's so much better than renting. And it's, I'm gonna say a falsehood. I mean, it's crazy when you actually look at some clients we have here, and we actually did have clients that bought a house in 2006 and they did not break even on that house until I believe it was 2019. They were underwater for 13 years. So don't fall into this kind of falsehood that, yeah, rental prices and house prices, they only go up. Not to mention here, I mean, gosh, we're getting way off track, but I do want to bring this up. We were talking to another client yesterday, and he was talking about, yeah, my home has climbed by this price, but because of the rent controls, I can only increase rent by, I think it was like 2 to 3%. I forget the exact number. That is not good for home prices long term because it makes it less attractive to be a landlord saying, well, I can't increase rents. That's not really creating a fair market there. So just be cautious is the point.
Yeah, and then we'll move on. But I just want to go back to that person who said that in 2006 they bought a home just finally broke even. I don't think that includes other expenses like the property taxes, the insurance, the maintenance, the repairs. I think if you put that back in the equation, they're still probably underwater by, I'm going to guess, maybe at least 10, maybe 15%, because this is one thing people don't remember is that it is a house is a depreciating asset, which means it falls apart.
Yeah.
The land doesn't, but the house does. So you got to put that in the equation as well. So, just putting the numbers in for people. So.
Yeah, so I mean, kind of a long way around it, but those are really our kind of projections for the real estate market in 2022. I did want to touch a little bit before we pick our stock for today is, people talk about rental property investing and kind of what that entails. And the big thing I want to say here, we talked about how overpriced houses are. That doesn't mean that a rental is going to be a great opportunity now because, well, all of a sudden things are expensive. I think your ROI, return on investment, is going to be quite low. Don't get me wrong, there might be some great opportunities out there, but you have to crunch the numbers. You have to know what you're doing. Don't just think you go buy a home and it's going to be great. And the big thing I want to point out is we deal with a lot of older clients that, they've done quite well in real estate at times, but they say, I'm 70 years old and I do not want to be a landlord anymore. And we just hear nightmare stories of being a landlord because it's not very favorable here in California.
Yeah, and the laws do favor the tenant, not the landlord. And actually, the landlord's kind of like a bad guy, where like, oh, you've got all this money, you should give that rent away for free almost. Maybe
Yeah.
someday it'll get there. It's not there yet, but sometimes we talk to landlords like, oh my gosh, the regulations and what we have to do. And just recently, to where they couldn't charge rent if the person lost their job. Well,
Yeah.
they still had to pay the mortgage. They still had to keep the upkeep on the home and maintenance and everything else for that rental property, and they couldn't. So you got to really, really dig deep sometimes to really understand what you're doing, because sometimes it sounds like a great idea. Check the numbers, may not be a great idea. So should we give our what we think is best, or you got another?
Yeah, I was going to say, let's move on here to our pick. And the reason we're picking this company is it's an office REIT, and that stands for a real estate investment trust. This is a much easier method to actually get involved in real estate because we always say the tenant's never going to give you a call here and say, hey, my toilet broke, can you come fix it? There's no problems there, and you still get the cash flows from the rent. I mean, what happens is these trusts, they go out and they buy real estate, and then as an investor in that REIT, well, you get the benefit of actually having those rents come into the company, come into the trust, and many times you get good yield. So with that said, let's get into our REIT that we want to talk about. Again, this REIT here is actually a office REIT, and what we want to look at is Piedmont Office Realty Trust Inc. Ticker symbol is PDM.
Yeah, and let me go with the evaluation ratios, because just like a company, you want to look at what you're paying for other items here. And I do have to kind of point out, Chase, unfortunately, on the screen right here, I cut off the industry average a little bit. We'd like to compare to the industry average. What's being cut off is our our photos there. I don't know if you can lower it down a little bit for me, maybe, so I can see a little bit more because the P, I can't see the P ratio. No, you're going up. You need to go the other way. Maybe you can't go the other way. So I might just have to kind of guess here a little bit. Let me kind of start off with the PE ratio. And REITs do have income. And we'll talk about something else in the future here. But right now, we'll just kind of focus on the price to earnings because these REITs, real estate investment trusts, do earn earnings. 9.8, that's a pretty good number. Look at the price to sales. It's 4.3. That's above the industry at 3.4. So that is a little bit expensive. You do have a book value. Price to book value is 1.3. That's well below the initial 1.9. That's a positive. And you love REITs because they have nice cash flow. Well, you're not paying much for the cash flow for Piedmont because the price per cash flow is 5.1, well below the industry at 18.4. Now, the big thing with real estate investment trust is the yield that you get from them. And this has a very nice yield of 4.6%. But what's important is how much of their earnings are they using to pay that out. They only use 45% of their earnings to pay it out. So that's a pretty strong yield. We don't see it being cut in the near future. A REIT does have sales. Their sales are actually down 1.9%. That sounds bad. But remember what we went through over the last year, the industry down 19.8%. We do see earnings per share were up 24.1%, when the whole industry was down 218.7. So that is better than the industry. That's what you want to see. Very important for a real estate investment trust, just like a company, is the balance sheet. Now, the current ratio here is not material versus 43 for the industry, but keep in mind it's a little bit different with the real estate. What is important is the debt to equity. How much leverage does this real estate have, this real estate investment trust? Well, Piedmont's done pretty well here, 88.1. Now compare that to the industry average of 256. And we do see this many times in real estate, a lot of leverage. We're very conservative. We don't like a lot of leverage, even in real estate. So I like seeing on Piedmont a strong balance sheet with an 88.1 debt to equity. You do want to see what the return on equity is, and Piedmont checks in at 12.7. The industry is a negative 3.1. Also, net profit margin. What type of profit margin you're going to make on this here? You have a home, a rental, you make a profit margin. Well, look at this profit margin that Piedmont has here. It's 44.3 versus a negative 6.1. Now, I will point out this would take some more research. That sounds pretty high. So you're going to make sure that they didn't sell off a building or something else, or perhaps the previous 12 months may have been a real bad negative, or there's some expenses there. So when you see a high number, don't just say, wow, that's what it is. Verify that number, check that number. That's what we do at our firm, Wilson Asset Management. We always check numbers if they sound too good to be true. Actually, we check all the numbers. And then lastly, receivable turnover, very important with a REIT. We see 3.4, not quite as good as the industry at 4.7. So if I was going to invest in Piedmont today, I would want to look into saying, how are they doing on the rent collection? Is that coming through okay? Maybe they had some problems because of the COVID era.
Yeah, and the thing I want to point out too is you notice we chose a office REIT. I mean, we talked a lot about the housing market kind of, I think, being overvalued. It's definitely not
Mhm.
a good time to get into housing in terms of individual properties. But the office REITs we think can actually do, I think, pretty well going for it. And the reason for that is, I mean, it was so depressed last year is, oh my gosh, everybody's going to work from home and office. Nobody's going to want to go back to the office. We just don't see that being the case. We think, and we have seen people start going back to the office, which will help this company continue to have rents and I think grow rents in the future as well. But with that
Change
said,
one, and just one thing, and let me just point on that as well, because one thing when I talk about is that you want to find a business like a office REIT because things aren't going that great from right now. That's when things are on sale. When everything's great again, we'll say 2, 3 years again, these won't be on sale. You want to buy things on sale when maybe there's some issues that are going to take some time to fix. So just look for things on sale.
absolutely, that's a great point. But looking at the current price here for Piedmont, you see it's $18.10. It is off its 52-week high that it achieved of $20.35. It has climbed off that low we saw last year during the pandemic of $11.26. Now with REITs, the real estate investment trust, I talk a lot about looking at earnings. But again, with the REITs, it's a little bit different. We want to look at what's known as the FFO, or the funds from operation. Reason being, is real estate, you have a lot of high depreciation costs, which is actually a non-cash expense. So it kind of gives you a little bit more detail in terms of the cash flow, which I think is going to be a lot more relevant in the real estate space than just pure earnings. Don't get me wrong, earnings are still important for these companies, but I like to look at a little bit more detail on the FFO. So with that said, let's look at December 2022. I see funds from operations are in the FFO of $2.02. We use a 16.6 multiple. That was a target sell price of $33.53. I mean, nice appreciation on this, not to mention well, we talked about that nice yield that you get with this company. And then also, too, there's only 3 analysts, which worries me a little bit. It is a smaller company. You see about $2.2 billion market cap. But those 3 analysts, they're pretty much in line with each other. You see the highs $2.03 and the lows $2.02. So even though less analysts than I like to see, very tight range, that's a positive. I think this could be an interesting investment to add to your portfolio, especially if you want to get more interested in the real estate space.
And Chase, let's kind of break this down a little bit too for people just kind of looking going forward. It doesn't take a lot to make a good return. And we said the stock price, I'm going to just use round numbers here, is about $18 a share. If it goes up just $1.80, goes up to about 20, you add that to that 4.7% dividend, you've got a 15% annual return. Now, if you can do that over, I think about 5 years, your money's going to double for you.
Yeah, I mean, it's phenomenal. I mean, I think people get too emotionally attached to actually going out and buying the properties. I think they like the feeling of working because they feel like they're earning something. But for me, I don't know. I think I'd sit here, take the rent, so to speak, from the offices and sit back, collect a nice yield, and hopefully some good capital appreciation there as well.
Yeah, and go have a hobby or go work doing something else that you enjoy doing, make more money on top while your money's working for you, as opposed to you working so hard for your money with one piece of property that. And what if you get bad tenants? Oh my gosh, let's not even go there. That's terrible.
Yeah, no, that's terrible. So, point being, I hope that helps with your real estate adventures. Hopefully, it kind of enlightens you a little bit more on the public REITs that we like to look at investing into. But again, with that, thank you for joining us today. If you like the content, please be sure to subscribe to our YouTube channel for upcoming stock videos. This should not be used as investment advice, as is for informational purposes. If you are interested in learning more about our investment philosophy, visit our website, smartinvesting2000.com. Again, that's smartinvesting2000.com.